One of the hottest topics in American political life right now concerns the need for balancing the federal budget. And a major component of that is what is the right tax rate for corporations? But one thing that's not as often discussed is the actual practical considerations corporations have to make with respect to taxes. You know, where are they supposed to locate? How are they supposed to operate, especially if they're multinational? So today, we wanted to focus in on some of the calculations companies have to do when they're thinking about splitting up operations across different countries and how they have to account for the fact that if you transfer goods through one part of your company to another and you don't pay taxes on it, the host countries are still going to want to extract taxes in the form of a transfer price. Hello and welcome to Of Significance. I'm your everyman host, Brent Buckwright, and with me as always is Dr. Steve Bronars. Nathan couldn't join us today as he is on assignment, but we have with us an expert on transfer pricing and all things antitrust, Dr. George Korenko. George, welcome to the pod.
Thank you, Brent. Thank you, Steve. I'm glad to be on with you guys, and I'm sorry I'm missing Nathan.
It's fine. You know, He sometimes can't handle certain fast-paced topics like transfer pricing. Speaking of which, in case you don't know, Dr. Korenko has testified in U.S. Federal District Court, U.S. Tax Court, and before international tribunals in antitrust, tax, and transfer pricing matters. In transfer pricing alone, he's written articles, given presentations, and prepared numerous documentation studies over the last 25 years under U.S. EEOCD and foreign transfer pricing guidelines in the pharmaceutical, biological, automobile, chemical, consulting service, recreational water project, and assisted living industries. That sounds like a lot of things, George. I got to be honest. Pick a lane.
It is 25 years, so, I have time to do a lot of things.
Fair enough. All right. I want to start, George. Did I explain transfer pricing correctly? Are there any other details in the matter that are kind of foundational to understanding what's happening here?
Yeah, I think at a high level, you got it right. Fundamentally, the way to think about transfer pricing is that it is a regulatory requirement. And so as you stated, when a company is transferring goods or services from one of its subsidiaries to another, and that transfer crosses international boundaries, the tax authorities for those different countries are going to want to charge taxes on the transaction. And in order to figure out what should the tax be, you have to figure out, well, how much was that transfer worth? And so the fundamental framework is, again, there's lots of regulations, different regulations that set the standards and the procedures that you have to use. But fundamentally, they're all looking at what would an arm's length price be? What would arm's length consideration be? That would be the amount that would be negotiated between independent parties for whatever that good or service was.
So help me ground this out a little bit. What would this actually look like in practice? If I was a company, what am I doing? What is the regulatory measures against me? Is it just greedy countries trying to get their cut of the profits? What's happening?
So to step back for a moment, transfer pricing itself is actually something that disciplines companies. And so doing that internally is actually sort of a best practice for a lot of companies. But what we're looking at here, let's take an example from the current events. If we're talking about cars that are made in Canada, and let's say it's assembled in Canada and then shipped to a distributor in the US, and then from the distributor to dealerships. So if I'm a car company and I've manufactured the car in Canada, and then I ship it to a distributor in the US, the US is going to get the tax on the vehicle once it's sold. But the Canadian tax authority wants to get tax on what happened in Canada. Now, what happened in Canada can be really complicated, and it's going to depend on the intercompany agreements that are set up for that particular function. They look at things like what are the functions that Canada is performing? What are the risks that Canada is taking in assembling and manufacturing that vehicle? And what assets is it using? And there's all sorts of ways it could be arranged. Canada could be performing a manufacturing function. It could be insulated from risk by its parent company. And the assets could be purchased by the parent company or paid for by the parent company. So it could be an arrangement like that. Or Canada could be a full-fledged manufacturing facility that bought its own assets, performs all of the manufacturing functions, and takes all of the risks associated with it. So there's a whole array of ways that could be structured. But fundamentally, Canada wants to know what are the functions, risks, and assets, and how does that affect what I'm going to charge for tax?
I have a couple one simple question and maybe a follow-up. So when I think about this, and I don't know when you were teaching econ, if you would have these examples like this, where you're going like opportunity cost, one of the ways to try to get that across is like, just because the company is like doing this, whether it's a good or service themselves, and they're not paying someone else for it, it's not really that they're saving on that, because obviously if you're paying an outside business for a part or a service, they're providing value to you that you look at it internally. So you said there's some discipline there. Do you mean that companies are already in, whether it's in their internal accounting system or whatever, already have maybe not exactly transfer prices, but have some way of measuring the values of these things, even if it's like within the same country, so that they're not really tax issues in the way that we're going to talk about later? Or is that something that they don't regularly do as a way to kind of keep track of? They're being more efficient by either outsourcing something or doing it themselves. So is that clear what I'm asking? Do they already track this kind of thing?
Yes, that's clear. And I think it depends company by company, but it is often tracked. And think about it from the perspective of the, say, the managers working for the two different operations. There are different profit centers, and the person in charge of the manufacturing profit center is going to want to be compensated based on their output. And so if their output's valued at zero, that's going to look bad.
Yeah.
And so very often you'll see when I look at company financials in either tax or transfer pricing or even antitrust, you see a lot of times that there are intercompany transfer prices in their accounting records. The issue is that the prices that they're charging are ones that they determine internally for whatever methods, whatever reasons. But transfer pricing for tax purposes needs to be done under a set of regulations. And so that gives you specific methods, specific things that you can and can't do. And so whatever they're doing internally, if it doesn't comply with what the regulations say they have to do, then you still have to redo it.
Okay, so let me follow up with this. This may be a dumb question, but when you describe this, it seems like you're maybe talking about something similar to if we had like a value-added tax type of thing. And I'm wondering, Brent has said you've worked on stuff in other countries, not just the U.S. If you already have a VAT system, is there already some kind of accounting for like, well, we're going to be taxed on the amount of value that we're adding? Is that one of the ways in which this is done, or am I kind of
or is it just because it's like a
point?
multinational company that they don't have that transfer between different actual organizations, so you can't see them sell it at a particular price, or they can't see the value that's added at that moment?
Right. And that's the I think the fundamental issue. So the value added tax is focused on what did this particular entity do in this country, and so we're going to tax it based on that. Transfer pricing is a little bit different in that we're not just looking at the value added I mentioned before. It's the functions, assets, and risks. And so I may have added value to something, but if I have added value to it and I bore no risk in doing so, I may be compensated differently than if I had borne that risk. And so there are arrangements, for example, limited risk distributorships, where a distributor takes a product and distributes it in a local country, but bears no risk that the product has any defects, has no risk of inventory. And so it receives a different return for that arrangement. And that really sort of is divorced from the VAT system.
Okay, that makes sense.
So you've got to come in. I mean, the companies are doing some form of this valuation themselves, but you're coming in and trying to say, is this, compliant with whatever the associated regulations are, or does this actually line up with what we think economically should be going on given other standards by the industry? To me, it seems like for a car part, that's a pretty straightforward calculation, right? Because you can just say, well, I see tons of this particular part being sold elsewhere, so I know what the extra dollar amount that's being added here is. So that percentage of whatever your final sale is would go back to the company in Canada. Like, what's the complicated part here?
So it can be that simple, where under the U.S. regulations, we call them cups or cuts, depending on the form of the property. But if it's a product that you see sold in the marketplace and all of the functions, risks, assets, the circumstances all line up the same, then you can use that as a benchmark price to determine what should be going on in our company. But it gets more complicated than that. As I mentioned, there are different sorts of arrangements that can affect that. And there's also things that aren't so easy, like a car part. So, for example, what if it's a patent? What if it's know-how? What if it's a service?
What if it's a good old stick-to-itiveness or gumption?
Those could be, I think, by different names. Yeah. Those could be intangibles as well. But there are transfers of intangibles that are, if employees have a particular set of skills, then they could be valuable.
I was at a conference once where a future Nobel Prize winning economist
Steve
referred
Runners?
to it. No, I'm not going to win one. But referred to a characteristic of workers that would be valuable as early birdness.
Yes,
kind of like stick-to-itiveness.
Sure, get the wormitude. Yeah.
So in this area that we're talking about, it seems like, I don't know, selection bias is the right word or what, but like if someone else is outsourcing this and we're doing it internally, do you sometimes make the argument, well, there's a reason why, even though you could list off a few things that look similar between this, the fact that we're not outsourcing it means, and so there's an actual transaction price and all that, there's something special about this process, whether it's, what we were joking about these different characteristics. Is that kind of an argument that you would make, that like maybe this seems like it's the gold standard benchmark to use this, but we're not doing that here, and here's why? Is that part of the argument?
Yeah, that is something that you can see, and that can be a valid argument. And so that's something that you have to evaluate. So is there something special about this manufacturing facility, for example? There may be, but then you have to look at that and you have to test it. So if I'm manufacturing a product at this facility in Canada and I'm manufacturing the same product in Portugal, and there's no inherent appearing difference between that. And maybe I've got a third party, independent manufacturer doing it in Germany, and they're all doing the same thing, and they're all doing it to the same quality. then that raises the question about, well, is there anything really special about that Canadian entity? On the flip side, there could be. Because there is very often sort of the make or buy decisions that are made, but there could be other reasons why they are manufacturing internally. So, do they have processes that the entities in Portugal and Germany don't have, or that couldn't use? Is there something about them that is special? And so that could be the case. But that does not necessarily have to be the case. And so there are different ways to deal with that. One way, for example, if I'm looking at manufacturing returns and I think I have an entity that is better than the average entity that I'm going to go out and look at, well, I can derive a range of returns for that manufacturing and give this entity something at the high end of the range. And so that would give them more than the average compensation, suggesting there is something different and better about them. But those are the sorts of adjustments that you could think about. I'm sure there are others, but that comes to mind.
Right. Like the calculation here that we're trying to do is how much of the profit should go to one part of the organization versus another, right? Or are they doing the calculation at each stage, and no matter what the outcome is, you get some flat rate for whatever it is you're producing?
So I think it's, again, it depends on how they set this up internally. So if I have a patent that was the result of R&D that was conducted in the UK, and then I'm going to license that to a US facility to manufacture this. Well, then I have to figure out what is that technology worth, and what is the US side of the transaction worth. And so there's a lot of complications behind how these things are set up. And for that car part that we were talking about, that there's a lot like it. That's a relatively more straightforward thing to do. But then when you're talking about things that are not traded every day, or things that are set up in a special arrangement where risks or assets have been allocated or shared in different ways, then it's not so simple.
I mean, sticking with this kind of pharmaceutical example, like if you come up with, say, a blockbuster drug that has just never existed on the market before, to me, it feels like intuitively almost all the value is coming from coming up with what that drug is supposed to be and the recipe for how to make it. How do you go about valuing what the manufacturing should be getting from that?
So that's actually an interesting question. So I've actually analyzed blockbuster drugs in the past, and I've actually written an article on it. See, that's what I do over the last 25 years.
Have you ever analyzed Netflix drugs? Because I hear they're streaming now. Yeah.
Not yet.
That must be a pretty old article if you're talking about Blockbuster.
Yeah. Boo. Boo us both. Okay.
Yeah.
There still is one. I taught an antitrust class, and
somewhere in like the Pacific Northwest or somewhere like that, or I can't remember exactly where.
Yeah, I think so. But when you're looking at a blockbuster drug, so what I've done in the past, we've been looking at what's the intangible property worth. And, for some clients, what I've done is we go in and we look at what agreements have you negotiated with other parties for licensing in technologies. And so they're licensing in patents for all sorts of different drugs, and some of them are worth more than others. But very often in the pharmaceutical industry and other industries as well, they do what's called a net present value or a discounted cash flow analysis. And so what they're doing is they're looking at the projected revenues and costs, and they're looking at those over time, and they're assessing the risk associated with those. And so that's a financial analysis that they do when they're deciding whether to license a product or not. Now, those analyses, if we look at them, and there's an evaluation process that has to be done. But if you look at those, they tell you how that pharmaceutical company operates when it's licensing products. And so the question then is, well, what would they do differently if they're doing this internally? At first blush, I would say, why would they do anything different? Now, the regulations have you look at things. They have you look at cuts, which comparable uncontrolled transactions, which what we're looking at there, they look at profit potential. Back to our blockbuster drug. Well, what if the profit potential is way outside the range that we've experienced when we're in licensing technologies? So what I've argued is that you can still use that experience. When you're trying to decide what share of profits go to the licensor and what goes to the licensee, I can still argue that I think they're going to behave the same way. Now, the cash that's going to be associated with that share is going to be a lot different for a blockbuster product, but the share may not be that different. And so, that's the approach on the intangible piece. On the manufacturing piece, you have to ask yourself, is there anything unique about manufacturing this blockbuster product? If I can manufacture that product anywhere in the world in my facility or anybody else's, well, then the manufacturing return doesn't need to be any different. If I manufacture that thing and it's pretty complicated, but I also outsource it, well, that means that it may not be all that complicated either. So you have to look at those things really. Each one is unique, and you have to look at the facts and circumstances, because just because it's a blockbuster doesn't mean you throw out the whole type of analysis that you've done in the past.
So if I was a corporation and I was trying to figure out where to manufacture, and I knew that as a part of the calculation, I would have to take into account the reality that, I could manufacture this in Germany and I could manufacture this in, Puerto Rico or some other place. Does that not incentivize me to just pick one location to manufacture it all from and argue that's the only place I can manufacture it?
Well, I think the argument that that's the only place you can manufacture it might be questioned by the tax authorities. Yeah. But what you do see, and I'll take the pharmaceutical industry, you do see a lot of manufacturing occurring in particular places. Puerto Rico, Ireland, Singapore. What's going on there is those are low tax jurisdictions. And the companies are often trying to, make their effective tax rate as low as possible, and to do it within the what's permitted by the regulations. And so when they're doing that, that location and the way that they've set up their structure ends up putting funds into Puerto Rico or Ireland or Singapore. And so they're earning a lot of money on these drugs, and a share of that's going to Ireland, and they're paying lower taxes on it. So there are structures where they are, I wouldn't say they can't manufacture it in anywhere but Ireland, but they are manufacturing in Ireland for a specific purpose.
Yeah, I would interject with a couple of things here. One, not to cast any aspersions on any of those wonderful low tax places you mentioned, but I think that companies are also looking at the risk of supply chain disruptions, and they may not want to put, you talk about a Nobel Prize winning idea, don't put all your eggs in one basket. Huh?
Ooh, if you put an equation to that, Steve, you can get that prize.
James Tobin won a prize for that. So that would be my first point, that there's other things that they're looking at other than just the taxes.
Absolutely.
Yeah. The question that I have, this is a little wacky, but it's more of like from an empirical, like you're trying to account for what's affecting something. And we think of in those empirical things, sometimes there's an interaction effect. It's the combination of these two things together that individually, I'm not sure what they are. I'm not necessarily manufacturing, but the R&D with something else, whatever. And that you could think this is pretty hard to disentangle how much each, because there's something about attributing to each individual division, some idea that there's not synergies from having these divisions together, right? And that you could just kind of divide that out easily. I think that's a pretty challenging thing to try to do, because you might say, Division 1, they're responsible for A, and then B to Division 2, and then between the two of them, C somehow needs to be divided. And that may be kind of a crazy question, but it just seems to me that it sounds easier said than done to try to figure out, are there these synergies or interaction effects or whatever you want to call them that makes it a little bit more difficult to say, what if we had just done this a different way than we're doing it? How would that have affected the bottom line?
Yeah, I'm thinking about a part of the value chain we haven't talked about. Think about the marketing function. So the marketing function can be contributing to the manufacturing, telling them, these features would be helpful. They can be contributing to R&D. Where should we be focusing our clinical trials in order to demonstrate that this product is better than its competitors? And so there's a lot of potential synergies. The transfer pricing guidelines, in a sense, don't deal explicitly with that. What they do is, if I'm trying to price a marketing function, I have to think about, well, is my marketing function doing something unique or better than if I went out and hired an advertising agency or another marketing agency to do something like that? And, very often there can be. So are there customer relationships that are important in driving sales of this product? Are there particular experience staff in the marketing department that are able to do things that couldn't be done, on the particular Madison Avenue places that we would think about? And so, again, everything is unique in transfer pricing, and you have to look at, is this marketing function doing something different than I could outsource? And if there's something that's different and I can try and measure it or account for it by making some sort of adjustments, then I should do that.
Yeah, we were talking with Craig about mergers and all that, and just the whole idea of like we're acquiring a business that will become a division of our company, presumably because you think there's some synergies there, because you don't need to like acquire them. You could just transact with them. So it seems like that's a pretty important part of it, is to recognize that where these things match up particularly well, that you have these different divisions working together that may not work as well if you had been, I mean, I don't know how that affects the overall valuation, but that would just be different than if you were like, oh, let's just outsource this to someone else.
Yeah. I mean, that all goes back to the putting on my economist hat, the theory of the firm, and why do you integrate? And,
right.
Those are all good questions, but the tax authorities are a little bit less interested in that. And they want to know.
Not surprising.
What should you have charged for that?
Yeah, right.
So in this last little segment here, I kind of want to get into, you've talked about some of the methodologies that you use to kind of do these calculations. I'm curious, what data do you actually look at? How are you thinking about what the right tool is for, each of these cases? Because I imagine they're all pretty bespoke.
They are, absolutely. And it is, there is a part of the U.S. regulations that's called the best method rule. The best method rule requires you to go through the different specified methods in the regulations and the even unspecified methods, and to determine what is the best method to apply to a particular transaction. Now, from my perspective, I've always thought that the best method rule is best informed by the data that are available. And so if I'm looking at an intangible transfer, the financial analyses that I talked about before are often the best information that's available. If I'm looking at a manufacturing function, the best method may well be to go out, and we have databases where we can look for companies that do similar functions, employ similar assets, and hopefully bear similar risks. And I can use their returns and say, okay, these manufacturing entities typically get a 7% markup. And so that's what my manufacturing entity should get. And there I apply that to the company's accounting records. So the data that we use varies depending on what the problem is and what's available. Again, so if we go back to the intangible, I've run across some examples where folks have tried to construct financial analyses after the fact to figure out what they thought an intangible was worth. But there's a lot of holes in some of those analyses that I've seen. And what that means is that it's not a reliable way to approach it. And so maybe you got to think about something else. So it's really, you look at the accounting data, you look at financial analyses, you look at what the company does with third parties. And that's sort of the starting point to figure out, okay, so what data are available to me to answer this question? And then you go through this best method rule and figure out how best to use those data to apply an accepted method.
It does sound kind of funny to me that the standard is use the best method. Like, oh, the law says don't do it the worst way possible. Oh, thanks. Thank you. We were going to do it. We were just going to guess. So using the best method, that sounds like a better idea.
Yes, it is. And so the wisdom of the tax code. But I would say, very often when I'm doing these, you select a best method, but, if I can, I often try to use a secondary method to see if I get a similar result. So it's always good to confirm your results
with
twice.
The second best method. The second best method. Yeah.
Yeah.
So George, when you're actually presenting all this stuff, you're presenting in tax court. Usually the stuff that we're working on is in federal courts. Are there any differences for you in how that information actually gets conveyed?
There are actually some big differences between what's going on in tax court and federal district court. For starters, tax court is, they're judges and they hear tax cases. And so they are specialized in that sense. Whereas in federal district court, when I'm testifying in an antitrust case, it could be the judge's first antitrust case, or that could be most of their docket. And so the specialization that occurs in tax court is one thing. I think the another big difference is sort of when you prepare your report in tax court, that is the evidence that you're putting forward. In federal district court, the evidence that you put forward in your testimony, live testimony, is the only part that's in the record. And so it's a difference in terms of what sort of standing your report has versus your live testimony. But otherwise, you do sit and do your direct examination, you get cross-examined, and hopefully the judge is listening intently.
Is it usually like just a judge, or are there no juries or anything like that? It would be a judge that would make the decision?
Right. In tax court, it's a judge.
Yeah, that is an interesting thing that, we write so many reports, but we don't really testify in court that much to realize that's just sort of like telling them what you're going to say if this gets to court, but we know that a lot of them don't. How does it work in the tax court? Do there are a lot of settlements, and so they don't make it to tax court, or do you have any idea what that is like, or is it more likely to go forward? I'm not sure how the government is willing to compromise on this, and certainly on the labor side, the there's a lot of settlements of cases where they don't make it to an actual trial.
Yeah, I mean, that's a good question. I think when I can speak to the transfer pricing piece. There's a lot of litigation that goes on in other parts of the tax code.
For sure.
But in the transfer pricing world, the IRS tends to litigate relatively few cases, but they tend to be very big cases. And so, there's every couple of years, there are large, I'll call them landmark cases, where the tax court is making a decision about something that was very important to the IRS. Obviously, also very important to the taxpayer. But those are there are relatively few cases that make it that far in transfer pricing. I mean, thinking about it, all the big multinational companies are getting audited. Often the auditor is sitting in-house and evaluating things there. And so audits are a big part of the process, and most things are probably settled, during the audit process rather than through court.
That makes sense. Yeah, it's, for those bigger companies, it's a pretty complicated thing that they're working through. So, and like you said, there are a whole bunch of other disputes other than just transfer pricing. So they're working on all of that.
Right.
So, George, I'm thinking about, right now I'm in Washington, D.C. Steve is in Austin, Texas. I'm thinking about selling some of our office supplies from the D.C. office to Steve. If you wouldn't mind, I've got a couple of transfer pricing questions that we can take off the pod.
Those are state tax issues, Brent. I don't do those.
Yeah, okay, great. All right, well, thank you very much for talking with us. And this has been Of Significance.
Thank you.
Thanks, George.
Well, that's been this episode of Significance. This episode's been brought to you by Edgeworth Economics, a leader in economic consulting, and with the help of our producers, Kimberly Krewald, Ryan Deal, and Brian McLamara of Brand Ready Media, with music by Armwell Lang. Thanks for listening, StatPack, and always remember to check your assumptions.